Now, I'm going to tell you something now which will not surprise one of you. Global dividends fell by $108 billion in the second quarter, with European and UK companies hit the hardest. That's according to Janus Henderson 2020 Global Dividend Index. Yet the asset management firm warns the fourth quarter is likely to see an even larger impact on payouts. Well, I'm delighted to welcome back to the show Ben Lofthouse, who joins us now. He is head of global equity income at Janus Henderson. Really good to see you today, Ben. Look, no one's surprised that the divvies and the buybacks have been cut aggressively. What they want to know is if they invest in dividends going forward and in income, that it's still going to be there 2, 3, 4 quarters down the road. And what I am beginning to see, and we saw a hint of it yesterday with Bunzl, is that companies that have been cautious are coming back and saying, we can give you some income as well. So tell us where we've been and tell us where you think we're going, Ben.
Yeah, good morning. So this report, we've done the figures since 2009, and so I guess this is the first time we've had a really big reset. And what you can see here is there's a massive discrepancy by sector and region. And I think that's probably the big takeaway from this. So if you're in, if you're in stocks that are really hit by the pandemics, particularly travel and leisure, airlines, and financial services, particularly in this case because of the regulatory involvement, then you've seen your dividends disappear. But then actually there are a lot of companies that have paid, and still quite a lot of companies, more companies than not, around the world that are growing. So actually, longer term, I think that the question you ask of can you expect your dividends to grow from here, I think the answer is yes. But I think, company by company, the outcome is very different.
Is the FTSE yield, and I'm going to go straight back to where we find the highest income players, is it still around 4% despite everything?
Well, I think when you look at 1 year forward, we're seeing figures like 3.6. So actually, the historic yield is high, but the yield is falling, and it's falling to a level that is still very attractive versus fixed income, versus bonds and other assets, but will be more in line with some other regions in the world.
You don't necessarily think that, I mean, again, I'm trying to find reasons why the FTSE is still 1,500 points plus below its highs of the year, where other markets are hitting record levels. And I can come down to, one, of course, the component mix, and two, the political situation. The political situation I have problems with because actually a lot of these are dollar earners anyway as well. So are you advising, I'm sure a large number of your clients come and say, well, what about the FTSE? What about the income you can get there? And you say...
I say it is the composition. I think when you look at other countries with similar sector biases, or the sectors within other countries, you've seen very, very stark underperformance from areas like energy, from areas like financials, and the UK, and areas like tobacco. So the UK has quite a lot of those areas. So I think the other thing I think that's affecting things are a lot of money is invested nowadays via ETFs, and perhaps to your point, the UK has some question marks, and actually, if you're not getting money into an area, then there is no momentum. You were talking earlier about momentum. There is no momentum in the UK stock market per se, and that makes it hard for companies, I think, to break out of that wider trading range.